everyone. Today we're going to cover the last chapter of this class, chapter 14, property transactions, determination of gain or loss and basis consideration. Okay, we have been talking about the tax returns, how to prepare tax returns, but now we're going to focus on a particular line, gain and losses that result from the disposition of property. Okay. So we start with the big picture scenario. We have Alice. She owns a house that she has received from her mother, Paula. Paula paid $275,000 for this house. Now, Alice is the owner and she's thinking about selling this property to her nephew, Dan, for $275,000. And she anticipates that there will be no gain or loss on this transaction. Then Alice tells you that she received the property from her mom, but around the time that she received the property, her mom died. Does that has any effect on this transaction when she decides to sell the property? Also, Alice clarifies that she received this property as a gift. Then she tells you that she is using this property as a principal home. So maybe you can explore certain options. If she needs to pay taxes, are there any benefits out there because she's using the property as a principal home? So what are the tax consequences that you as the tax advisor should consider? What are the questions that you should look into or should start considering? What is the current fair market value of the house? Yes, that is a very important question because if there's a gain to determine, you need to know what was the fair market value of the house. What are the consequences of this sale that she intends to do to her nephew, given that they are related parties? What are the tax consequences whenever somebody is receiving a property as a gift? Okay. So that is something that you need to keep in mind. Then Alice tells you that she has a boat that she's trying to sell and she paid $22,000. She's thinking that she's going to get $20,000 to $23,000. So we don't know. She might sell it at a loss if she sells this at $20,000 or at a gain if she sells this at $23,000. Then she also tells you that she has some stock in Green Corporation and she is selling this stock as a loss. Okay, so what is your job? You need to read the chapter and try to provide answers to your client, Alice. And as always, I like to prepare diagrams so you know what's going on. First, this is a diagram that's just showing you that there are related parties here. Paula is Alice's mother and Alice apparently has a sibling and the sibling has children, and Alice is related to Dan, who is, over the age of 18. Not that it matters in this case, but it can be relevant in other situations, okay? If we are talking about dependents, the family relationship is important. If we are talking about qualifying relatives, the family tree is very important. Not so much in this case, just to help you see that Alice and Dan are related. What is important is to remember that Alice received the property from her mother and she received that as a gift. Okay, so here mom is mom and she gifted the property to Alice and this is a gift, as opposed to a sale transaction, because there are different tax consequences whenever you receive a property as a gift or as a sale, as a result of a sale, a payment that you made for the property. And here's a summary of what's going on with Alice. Alice has multiple properties, real estate, a boat, a stock in a corporation. And the values, the cost and the fair market value are very important always. So this is a summary for you to see this in a picture. Now let's start with the determination of gain or loss. Where are we here in the tax return? This is your real tax return. While you were completing your tax forms in chapter 3, I hope that you had the opportunity to see the tax return, how it looks like. If not, here it is. It starts with information about the taxpayers, the Social Security number, filing status, the deductions, generally, if you're claiming a standard deduction or not, certain information related to your digital assets. The IRS is gathering information to make sure that you are reporting if you're selling these assets, and then information about your dependent. If you have claimed a head of household status, it's very important that you show that you have a qualifying relative or a qualifying child and that the information is here. Then we are gonna, again, share information about your income and the different type of income that you may have. But here in line 7, specifically, we are gonna deal with capital gain or loss, and you're gonna have to provide additional information about the sale of your capital assets. Okay, so this is the graphic that the book shows you. I just wanted to show you, the real tax return. This is what the tax return looks like. Okay, so here, line 7, you have capital gain or loss, and they also tell you that you have to attach a Schedule D. Here you have a Schedule D where you're going to provide important information to the IRS, like the sales price. First, we're going to categorize your assets in short-term capital gain assets and long-term capital gain assets. And you're going to provide information about how much money you receive from the disposition of your asset, meaning the sales price, then what is your cost, what is your basis, and then we are going to calculate the gain. Okay, so that is Schedule D. Now let's talk about determination of gain or loss. Generally, a taxpayer does not recognize gain until there has been a realization event. Okay, so there's no recognition, meaning we do not have to pay taxes whenever there is a gain until there has been a realization event. So we need to look for this realization event. What is it? When does it happen? This realization event will happen whenever we sell an asset or whenever we transfer or dispose of this property. So we generally know this transaction as a disposition of property. So let's analyze the sale. The sale is something very simple to understand because you have seen it, you have experienced it whenever you purchase certain assets, personal assets, or real property and any other type of assets that you have ever purchased. After you purchase a property, there's a change in ownership rights. And for the seller that has generated a gain, well, that is an event that will require that this seller pays taxes on that. Now, there are other ways to trigger this realization event, and those ways are generally known as other type of disposition of property. And those are, for example, trade-ins. And whenever you are purchasing a cell phone and a carrier company asks you to give your older version of your iPhone, and then they're going to reduce the price. So that is also a disposition to consider. We need to review that transaction to see if that has generated a gain or a loss for the taxpayer. So trade-ins are used articles accepted as partial payment. Casualties, certain deductions that you're allowed to take whenever there is a loss or destruction of property due to an unexpected event like a storm or accident. Then if you have incurred in a loss, there are certain rules that will allow you to recognize either a gain or a loss as a result of that situation. Condemnations. Condemnation is the process where a government takes your property because they need it for the public. It's a forced sale. They are taking your property because they need it for the public, but they are going to pay you for that. And if the result of that transaction is a gain, you will have to recognize the gain. You will have to pay taxes on that gain. Then we have thefts. In thefts, the property has been stolen, and if there is a loss, you can claim a loss if we're dealing with assets used in a business. But if we are dealing with personal property, then there's no loss that you can recognize. Bond retirements, when a bond issuer pays off a bond before maturity, the holder has disposed of that bond. Okay, so We're just here changing ownership or something is going on with the property is destroyed and we receive compensation from the insurance company. And that is kind of a way of receiving a payment. And if we analyze the transaction, calculate the numbers, if we are allowed to get the loss, we claim it. Or if the transaction results in a gain, we have to pay taxes on the gain, okay? So first, you know what can generate a realization event. That is very important. Now let's look at what we are reporting. You are reporting any realized gain or loss. A realized gain or loss is a difference between the amount realized from the sale or other disposition. And we know what we're talking about when we say sell or other disposition. So this is the triggering event. The sale, the trading, the casualty loss, the condemnation, the bond retirement, that is the triggering event, the disposition. So now we have to compare that with our basis. So the triggering event will result in an amount realized. For example, in a sale, what is the amount realized? Well, the purchase price. I'm just giving you a general example. The purchase price is your amount realized. You have to compare that with your adjusted basis or with your basis or with your cost. If there is a difference there and that difference is positive, well, that is a gain. That will be your realized gain. But if the difference is negative, then that will be your realized loss. Another way to see it here, there's a graphic. Amount realized is any money received plus, sometimes we don't just receive money, we receive other property, like in tradings, you are receiving fair market value of any other property, you're receiving another cell phone. So the amount realized plus the fair market value of any other property plus any debt relief. So sometimes you are selling a property and you are receiving cash, but the buyer is also assuming a debt. So that will be a relief of indebtedness. If that is the case, that's something that you have received. You have to account for that as well. If you are incurring in costs, that will reduce your amount realized, okay? At the end of the day, that is a summary of what you have to look into whenever you're looking at the amount realized, because what is it that we're trying to find out? We're trying to find out this. Are we realizing a gain or are we realizing a loss? So we're trying to see what is our amount realized. And then we're gonna compare this amount, or we're gonna subtract the adjusted basis. The adjusted basis is the cost on the date of acquisition plus any capital improvements or additions. If you have spent money on this particular property to increase its useful life, then you have improved the property. So that will increase your adjusted basis. But this basis will be reduced if you have recovered your cost, if you have depreciated the property, if you have amortized the property. So that is what adjusted basis is. We start with your basis, with your general cost, and it can be increased or decreased depending on how much you have spent on that property. I think this graphic is simple enough. Now let's look at the determination of gain or loss. So the amount realized would be any consideration received. Consideration is what is it that you're receiving in exchange of this property that you are giving to somebody else. So it can be cash, fair market value of other property received, mortgage loans transferred to the buyer. Here again, it's very easy to see it in the graphic. Amount realized is cash, money received, plus fair market value of any property received, plus any debt relief. Any debt relief, that is something that will increase your amount realized. Now, there is a particular definition for fair market value. During the whole class, I have been putting these FMV letters to show you fair market value, fair market value. Hopefully, by now, you kind of have an idea what fair market value is. But there is a particular definition in the code, and it is the price determined by a willing seller and a willing buyer where neither is compelled to sell or buy, and both have reasonable knowledge of relevant facts, okay? And all this, the amount realized will be reduced by any selling expenses. Okay, so amount realized is equal to cash plus fair market value of other property received plus debt relief, and then reduced by selling expenses. Here we have an example. Example 6. Rich sells an office building and the associated land on October 1st, 2025. Great. Under the terms of the sales contract, Rich will receive $600,000 in cash. The purchaser will also assume Rich's mortgage of $300,000 on the property. To assist the purchaser, Rich agrees to pay $15,000 of the purchase's closing costs. This is called a closing cost credit. So the broker's commission on the sale, $5,000. You know, whenever we are selling property, there are certain fees that you have to pay to the broker. Rich said, hey, I'm going to assume that. I'm going to pay for that. And also closing costs, I'm going to pay that. So broker's commission and closing costs. So here's a summary of what's going on. What is it that Rich is receiving? Because we started with cash. Yay, that's very easy to determine, 600,000 plus fair market value of any other property received. Any other property that Rich is receiving? No. Okay, then we continue. Plus any relief of indebtedness. Here, purchaser, the buyer, is assuming a debt that Rich had to pay. Well, that is a relief, that is a payment that somebody else is assuming. It's as if this buyer had given that $300,000 to Rich. If you look at this transaction like that, you can notice that what he is really receiving is $900,000, right? That's why we add that assumption of liability. So that is what Rich is receiving, less any expenses that he is incurring in the sale of this property: broker's commission, cost, closing transaction costs, closing costs of $60,000. So that will reduce the amount realized. Again, at the end, the amount realized will be $840,000. Okay, great. Now let's look at the adjusted basis, because our formula, before we determine if there is a gain or loss, we have to compare our amount realized with the adjusted basis. The adjusted basis of a property is the original basis, but it will also consider any capital additions, any improvements that you have capitalized, and it will be reduced by capital recoveries. If you have claimed any depreciation on the property or amortization on the property, that will reduce your basis. So we start with the original basis. What is your original cost whenever you purchase the property on the date of acquisition? And then we're gonna increase your basis with the capital additions and decrease it with any capital recoveries. Here, the formula is very simple. Capital additions. So now that we know that we have to compare our amount realized with our adjusted basis, we know that our adjusted basis will start with the original purchase price, for example, with the original amount that I have spent to acquire a property. But during the years, while you are the owner of this property, you may also incur in certain expenses that can be capitalized, meaning these expenses will increase your basis. That's what it means. And if we have the right expenses, then it will increase your basis. So these are capital additions. So the cost of improvements made to the property that extends the useful life of a property. So these expenses need to be substantial. If we are talking about a house, for example, we are referring to the expenses such as change of a roof, change of the driveway, installing a swimming pool in the property, changing the AC system, all those expenses. However, if you are just incurring in general expenses related to the repair of your property or necessary for the maintenance of your property, these expenses cannot be capitalized. They will not increase your basis in the property, okay? And depending on whether or not you are incurring these expenses related to a business or income producing property, you will be able to claim a deduction. What do I mean? If the expenses are related to business or income producing property, you will be able to claim a deduction every year. For example, cutting the grass of this particular property that you're renting as an Airbnb. Okay, there's a business there. You're using this real estate for your business, that is renting the property, and those expenses are ordinary and necessary. You can claim a deduction for that. But if you're just incurring in expenses to cut the grass of your personal home, then that will not give you any deductions. You are not allowed to claim any deductions related to those expenses because the expenses are related to personal property. Okay. So continuing with basis, with adjusted basis, we know that adjusted basis is your original basis, your original cost. You will increase it with your capital additions, and then you will decrease your basis with capital recoveries or cost recoveries, and that will give you your adjusted basis. So whenever we try to figure out is there any decrease in the basis, we need to see what is the history of this property have been. We need to review the history of the property. We need to see if we have been getting depreciations or amortizations in the property, because that will reduce your basis. Okay, here's an example. The machine Juan sold in example 3 was acquired 4 years ago for $100,000. It was a 7-year Macros property, and Juan did not take either an immediate expense deduction or a bonus depreciation of a property. This is very important. So we use the Macros method to get depreciation on this property. And they are clarifying no 169 depreciation because that allows you to get a full depreciation in 1 year or the bonus depreciation. So no, we didn't do that. This is the schedule that we follow to get depreciation on this property. The original cost was $100,000. We apply cost recovery over 7 years. We have been depreciating this for just 4 years. So according to the Macros table, we are accelerating the depreciation. And this is what we have been claiming. First year, $14,290. Second year, $24,490. Third year, $17,490. And the last year, $6,245. What is the total amount of recovery or the amount of depreciation so far in 4 years? $62,515. So what is the effect on our basis? What is the impact? Well, this amount will reduce our basis because we already recover our cost. Okay, so my cost is not 100 anymore. I have been recovering my cost over the years. So at the end of the day, your adjusted basis will be $37,485. Okay, so this is what the example is trying to show you. Since Juan's amount realized on the sale was 56, his realized gain is $18,515. Why? Because our gain or loss is just the difference between the amount realized and your adjusted basis. And now you can see that also here in this graphic, your amount realized is $56,000 minus the basis $37,485. And your total gain will be $18,550. Now, capital recoveries decrease the adjusted basis of property. So you are recovering, and we talk about here depreciation. That is a way to recover your cost, right? But if we had a property that was lost during a particular disaster, then many things may happen. You may have received some proceeds from the insurance company. And what is that? What that is going to do to your basis? Well, you have recovered part of your cost of that property, right? It's as if you have sold it and somebody pay you for that property. That's kind of the equivalent if you want to look at this transaction as a sale. Another way to recover your cost is whenever there is a loss as a result of a disaster. So these are the casualty and theft losses. And you receive payment from the insurance company. So it's as if the insurance company is paying you and as if you were selling the property to the insurance company. Okay, so you're getting money, you're losing your property, and you're getting money. So how much do you pay for the property? Whatever the basis is, you have to compare with the amount that you have received, and that will help you to determine if you have any gain or any loss. Okay, adjusted basis is reduced by the amount of the deductible loss, or adjusted basis reduced by the amount of insurance proceeds received. Okay, we're gonna see an example. We're gonna run the numbers so you can see this very clearly. Example 9, an insured truck that Marvin used in his trade or business is destroyed in an accident. At the time of the accident, the adjusted basis of the truck was $8,000. Okay, very important, $8,000. And its fair market value, $6,500. Marvin receives insurance proceeds of $6,500. The amount of the casualty loss is $1,500. How do you calculate that? Well, it's your adjusted basis minus your insurance proceed. Your adjusted basis is how much Marvin paid for this truck, $8,000. How much he's receiving from the insurance company, $6,500. What is the difference? $1,500. I mean, this is the amount of money that I will never receive. Is a loss that Marvin can claim because this is a loss related to a business property. Perfect. So the adjusted basis after the loss will be 0. Why? Because we have the original basis. The original basis of the property was $8,000. Marvin will be claiming a deduction, a casualty loss of $1,500 minus the insurance proceeds that will result in a basis of $0. At the end of this or this transaction, we are going to get a basis of $0. So how our basis is affected by the receipt of proceeds and the calculation of losses. So the adjusted basis will always be reduced by the amount of a deductible loss. And this just means that I am allowed to claim a deduction for the loss of this property. Is he claiming a deduction for the loss of a truck? Yes, because deductions are allowed for the loss of property as casualty losses as a result of a disaster, federally declared disaster, and also state declared disaster, as we have reviewed before. Okay, so this is what is happening. Marvin is going to be claiming a deduction. Okay, that deduction will reduce his basis. Okay, and the payment that he received from the insurance company will reduce his basis. Basis for Marvin will be 0. Now, example 10, capital recoveries. Now we're looking at example 9. How will you answer example 9 if the basis of the truck was $6,000, its fair market value was $9,000, and Marvin received a $9,000 insurance settlement? Now we're changing this to create a gain. The basis of the truck, $6,000. Fair market value, $9,000, and Marvin receives $9,000. So the insurance company is actually paying the value of the property loss. It's $9,000. But it just happened that it's not what it cost Marvin to acquire the property. So Marvin will have to recognize a gain here. We were going to call it casualty gain because it's the result of this situation, this disaster. So Marvin will record a casualty gain of $3,000. Just the difference, the insurance proceeds minus the adjusted basis. This is very easy to see. The adjusted basis will be affected by this transaction? Yes, because the basis is reduced if you claim a deduction, but is increased if you recognize gain. So the truck's adjusted basis is increased by $3,000, will be reduced by the proceed. At the end of the day, it will be 0 as a result of the whole transaction. But we're just looking at how the basis is changing as a result of a gain. So you will start with your basis before the casualty, $6,000, the casualty gain, the gain that you have recognized, $3,000, and you're going to reduce it by your insurance proceeds. At the end, you're going to end up with a basis of 0. Okay, so Marvin basis becomes 0 after the transaction. Great. Okay, so let's continue looking at how our basis is affected, either increasing or decreasing. And here we're going to see that our basis is decreased because I am recovering my investment. And the particular scenario that we're looking at are corporate distributions. Whenever a corporate distribution is happening, I mean, your investment is in the stock of a corporation, and the corporation is giving you money as a distribution, right? And we have learned that whenever you are receiving money as a distribution from a corporation, that is called what? I know that you know it, you're probably saying it, a dividend. So my corporation is giving me a distribution, and that is called a dividend. When I receive a dividend, the tax treatment on that dividend depends on whether or not I have retained earnings on that corporation. If there are retained earnings on that corporation, that portion will be taxed as a dividend, and the tax rate will be between 0 and 37, depending on the filing status, your tax bracket. The next portion of that distribution, if I don't have enough earnings and profits, will be treated as return of my investment that will reduce my basis. So this is what we are talking about here. You have corporate distributions, and the non-taxable part of the corporate distribution will be treated as a return of capital, return of your investment, okay? And here we are trying to emphasize the fact that this non-taxable distribution, that is the return of your capital, will reduce your basis. Great. Now let's look at amortizable bond premium. Whenever we purchase bonds at a premium, it means that we have paid a certain amount above the face value, meaning the face value, the value of this bond once it matures is $100,000. Well, I pay 110. That 10,000 is my premium whenever you're dealing with bonds. If you're amortizing the value of the premium over the years, that amortization will reduce your basis. That's it, okay? Amortization deduction is allowed for taxable bonds. For taxable bonds because the premium is viewed as a cost of earning the taxable interest from the bonds. So that's another thing that you need to remember. The amortization deduction is allowed for taxable bonds. Are there non-taxable bonds? Yes, municipal bonds. Municipal bonds are not taxed. And if you amortize, you are going to have to amortize and follow on a schedule, but you're not going to get a deduction for that amortization. So just keep in mind these details. We are talking about amortization related to taxable bonds. And I think I have an example here. Example 11, Antonio purchases Eagle Corporation taxable bonds with a face value of $100,000 for $110,000, paying a premium of $10,000. The annual interest rate is 7%, and the bonds mature 10 years from the date of purchase. So the annual interest income is $7,000. If Antonio elects to amortize the bond premium, the $10,000 premium is deducted over the 10-year period. So what's going on here? He just purchased a bond, pay a premium, $10,000. He can elect to amortize, yes, because we're dealing here with taxable bonds. And in fact, they are telling you, hey, every year is going to get an interest of $7,000. That is my portion of a taxable income. But he is also electing to amortize this premium over 10 years. Great. So if I amortize that, it means that I'm getting a deduction. Let's say they're amortizing $1,000 per year, a deduction of $1,000 per year, and that will reduce my basis every year that I'm claiming an amortization deduction. So Antonio's basis for the bond is reduced each year by the amount of the amortization deduction. And if the bonds where tax-exempt amortization of the bond premium and the basis adjustment would be mandatory. So yes, you have to amortize the premium. However, no deduction will be allowed for the amortization. For tax purposes, you're not allowed to get a deduction, that discount that you get to reduce your taxable income. You're just not allowed to get it. Determination of gain or loss. Now we're looking at other ways to recover our basis. Just as a recap so we don't get lost. What are the ways that we're looking at? We are here. We are dealing with basis. We know that we have to compare our basis with amount realized. We know that our basis increases with capital additions, with improvements, but decreases with capital recoveries. Okay, so we are here. We're looking at what are the capital recoveries. My depreciation will decrease my basis. Then casualty and theft losses and insurance proceeds that I'm receiving will decrease my basis. Okay, any casualty losses will decrease your basis. And here we have an example where the gain actually increases your basis. Just an example so you could compare. But again, we are in the world of recoveries. Recoveries, a casualty loss, a deduction that I get for my loss, my casualty loss will decrease my basis. Okay, another way to decrease your basis, non-taxable distributions from corporations. Another way, amortization of bond premiums. I'm getting a deduction. Okay, I'm going to reduce my basis. Now we're looking at easements. What are easements? Well, this is a legal term. Easements are the rights to use somebody else's property. Maybe the right of way because somebody needs to install utility lines, roads, pipelines. So you are relinquishing certain rights on your property and you are receiving an amount. It's as if you were receiving payments for the rights that you're losing, the rights that you're giving to somebody else. Okay, if you are receiving payments, then your basis will decrease. Okay, again, we are looking at how our basis is decreased. Here, whenever you are reviewing an easement situation, somebody has relinquished certain rights on their property and receive compensation, something in exchange for that, that will reduce the basis. Okay, so now that you know what is your amount realized and you have your adjusted basis, then you can calculate the amount of gain or loss that you have to recognize. So what is your recognized gain or loss? Is your amount of realized gain or loss that is included or deducted from your gross income. The entire amount of a realized gain or loss is recognized. Non-recognition of gain or loss. In certain cases, a realized gain or loss on a property disposition is not recognized. When is that? Realized losses. Generally, we're dealing with losses because the IRS will not allow you not to pay gain unless it is excluded for certain reasons, but that is not the case generally. So gain is generally fully taxable, fully recognized. Here, when we're talking about non-recognition, we are actually talking about losses. So in certain cases, a realized gain or loss on a property disposition is not recognized. Okay, so realized losses from the sale or exchange of business or income producing property between certain related parties are not recognized. So generally losses are the ones that are not recognized. Why? Well, if the transaction is happening between related parties, we are kind of suspicious of the transaction and we are going to disallow the loss because why? They are related parties. The IRS doesn't trust that you are engaging in something that is called an arm's length transaction, where you are a willing buyer entering into a transaction with a willing seller where nobody is compelled or motivated to sell the property and use different prices other than the fair market value. Okay, so if that is the case, if you are related parties, whenever there is a sale or exchange of business or income producing property, we are going to disallow those losses. There will be no realized losses because that is what you want, right? Hey, I sold this property to my family member and I want to claim the loss to potentially reduce my taxable income that I generated somewhere else. That is what we're trying to accomplish. By the IRS will say, because you are related parties, whenever you're selling business or income producing property, we're not going to allow you to realize any loss. Okay, but you, professor, keep emphasizing business or income producing property, business of income producing property, losses related to business or income producing property. What's going on here? Well, whenever there is a loss that results from the sale, exchange, or condemnation of personal property, there's not going to be any recognition for tax purposes. Okay, only whenever you are obtaining loss related to business or income producing property. Okay, whenever we're dealing with personal use assets, then there will be no recognition of losses for tax purposes. That is the world of losses. Whenever we're dealing with gain realized from the sale or other disposition of personal use assets, that is generally fully taxable. So it doesn't matter if it's personal use or business use of assets. If there is a gain, it will be fully taxable. So now let's go back and look again at the big picture scenario. We have Alice. Alice is selling her boat for $23,000 and her basis is $22,000. Now we have to calculate the amount of the gain, how much gain we have to recognize. And hopefully you remember the formula. Recognized gain is equal to amount realized minus adjusted basis. Amount realized is any cash plus the fair market value of any other property received plus any liabilities that the buyer has assumed. In this case, we don't have any of that. She just received cash. The amount realized will be $23,000 minus adjusted basis. She originally paid $22,000 and it seems that the basis has not changed. Since then, there are no improvements that can be capitalized because they have extended the useful life of the asset. So the adjusted basis will be $22,000. Also, we are assuming that she has not depreciated this asset. Okay, under the scenario, this was a personal use asset. Okay, so we know that she has not depreciated this asset, and this is just simple. We need to subtract 22,000 from 23. The result is 1,000. That is the amount of gain. Now we're going to talk about basis considerations. Generally, basis is straightforward whenever you're purchasing a property because it will be your cost of purchasing this property. However, there are certain transactions that you will have to consider very carefully to determine what is the basis. So one of these type of situations where you need to be careful with determining basis is a bargain purchase. This transaction happens generally between related parties, and your employer, for example, will transfer a property where you're going to have to pay a certain amount that is less than the fair market price. The difference for the IRS will be treated as a compensation, and you will have to pay income taxes with regards to this difference because it is income for you. Similarly, when you are dealing with a corporation where you are a shareholder and you are acquiring a property for less than the fair market price, that will be treated as a distribution. That is a distribution, that is a dividend, and as a result, you will have to pay taxes on this amount. Well, here in these particular situations, you are acquiring a property and you are paying money, but the money that you're paying is less than the fair market value. So we cannot say that your basis is just the amount of money that you pay. Your basis will be the fair market value of the property. Okay, so in summary, these are transactions between related parties where you're paying less than the fair market value. You will have to pick up the income and pay taxes on the difference, and your basis will be the fair market value and not the purchase price, which is what generally happens whenever there is a sales transaction between unrelated parties. So now let's look at an example. In this example, example 14, Wade buys land from his employer for $10,000 on December 30. The fair market value of the land is $15,000. Wade must include in his gross income the difference, $5,000, because that's the difference between the amount paid and the fair market value. And this difference will be called the bargain element. And this represents, in this case, an additional compensation. So as we have learned previously, the basis will not be the amount that he paid, the basis will be the fair market value. So the answer here will be basis for the land, $15,000. So here we have a summary, we have the purchase price, we have the fair market value, and the difference will be the bargain element, and it would be the additional amount that Wade is receiving as a compensation. So the basis for the land will be, in this case, $15,000. We are going to focus now on identifying particular situations where finding the basis can be tricky. What type of transactions I'm talking about? Whenever you're acquiring securities, you're acquiring stocks, you're acquiring different type of assets in a portfolio investment, it is kind of hard to identify what is the particular basis allocated to the particular item of your portfolio. Unfortunately, you have to identify these particular items and you have to allocate the basis, because we need to know what is the gain that the sale of this particular stock or bond will generate in the future when you sell your stock. Okay. If you purchase different type of securities, different type of stock, we need to know when you purchase the stock, because we need to determine if you have a long-term asset or short-term asset, because different tax rates will apply if you have a long-term versus a short-term asset. Generally, whenever you're dealing with, these big financial institutions or a broker, they will provide to you an annual report showing what was the basis and then what particular item or stock was sold and what was the gain generated by these transactions. Okay, so now we're dealing with a lump sum purchase where we are acquiring different assets. We have to allocate the basis to these different assets. It is very important because some assets might be subject to depreciation, and I need to know what is the exact basis that is going to be my base for my recovery cost. Then you are going to sell probably this asset in the future, and that's why you need to know what was your basis. Some assets may be subject to special regulations because they are capital assets or Section 1231 assets. And you need to know which items will be subject to this particular regulation and what was the basis. So now, whenever we're dealing with a group of stock, whenever we're dealing with multiple stock whenever we're dealing with the stock that you have purchased different times and you cannot identify which ones are the one that you're selling first, we are going to assume that you're selling first the ones that you acquire the earliest. This is the famous FIFO presumption, first in, first out presumption. Example 15. So Polly purchased 100 shares of Olive Corporation stock on July 1st, 2023 for $5,000. That means $50 a share. And another 100 shares of Olive stock in July 1st, 2024 for $6,000, $60 a share. Then she sells 50 shares of the stock on January 2nd, 2025. Now we need to determine what is the basis because we want to calculate the gain, right? What is the basis of the stock that I am selling? Is it 50 or 60? In determining the gain or loss, the cost of the stock sold and that Polly cannot adequately identify the shares is 50 a share or $2,500. Polly was able to identify the share and say, hey, really what I'm selling is just this group of shares that I purchased for $60 a share, then we can arrive to a different calculation. But in this case, she cannot, so we're just going to assume that she's selling the ones that she purchased at $50 a share. So here in the summary, Polly purchases 100 shares of the stock on July 1st, 2023 for $5,000. And then 100 shares for $6,000. Now we're applying FIFO, first in, first out. So she has 100 shares that she purchased at 50 a share, and she's just selling 50 now. So 50 times 50 shares, that will give you $2,500. Now, let's talk about another important transaction. Now, we're not talking about a difference in time that we cannot identify the time. Here, you are purchasing multiple assets at once, and you need to allocate the basis. How are we going to allocate the basis? Well, you're going to have to look at the fair market value. So the allocation will be based on the relative fair market value. And here we have an example. Here, Harry purchases a building and a land for $800,000. So we're purchasing two assets, a building and a land. Because of the depressed nature of the industry in which the seller was operating, Harry was able to negotiate a favorable purchase price. An appraisal was conducted, and that allowed us to determine that the fair market value of the building was $600,000 and the fair market value of the land was $400,000. So Harry's basis will have to be allocated based on the relative fair market value. So we need to see what is the proportion of the fair market value compared with the total fair market value here. So we need to find our allocation formula because we need to determine which portion of the basis I am going to allocate to each asset. Okay, so the formula, the basis for each asset will be equal to the first market value of each particular asset divided by the total fair market value, and that will have to be multiplied by the purchase price. Okay, so the basis for each asset is equal to the fair market value of the asset divided by the total fair market value times the purchase price. So in this case, we're just looking at the building here. You see building. The fair market value of the building is 600,000, the total fair market value 1 million, and you have to divide those amounts and multiply it by the purchase price. In this case, the purchase price is $800,000. The result is 480,000. That will be your basis for the building. Now, basis for the land, fair market value of the land 400,000 divided by $1 million, which is the total fair market value, times purchase price, and that will give you your basis for the land, $320,000. Okay, now let's look at a different type of transaction, a purchase where goodwill is involved. We are purchasing multiple assets, and one of the assets that we are acquiring is goodwill. So whenever we have goodwill, what's going to happen with my basis? How do I allocate purchase price? According to the rules, you have to assign the purchase price to assets other than goodwill based on the fair market value of the assets that you are acquiring. And if there is anything left, that is the purchase price that you're going to allocate to goodwill. What happens if there's no amount left? Well, then goodwill will have no basis at that point. Okay, here we have an example 17. Wim sells his business to Renata. Okay, so we're selling a group of assets, inventory, customer lists, machinery and equipment, building, land, and also goodwill. So here we were able to obtain an appraisal indicating the value of these assets. The inventory value was $50,000, customer list $50,000, machinery and equipment $150,000, machinery and equipment $150,000, building $400,000, land $100,000. So after negotiation, Wim and Renata agree on a sales price of $1 million. So we want to allocate the sales price because that would be my basis on the acquisition of these assets. So we're going to start allocating the sales price to these assets. First, to anything that is not goodwill. So inventory 50, customer lists 50, machinery and equipment 150,000, building 400,000, land 100,000. All that, you need to add that, and that will give you $750,000. Whatever is left, in this case, $250,000 is left, that will be the value of goodwill. Now let's look at non-taxable stock dividends. This is a type of transaction that happens whenever you, as a shareholder, are receiving some stock from the corporation. Okay, so the corporation is giving you dividends, but they are not giving you dividends in the form of money. They're just giving you more stock. And this transaction will not be a taxable transaction because you are really not receiving money, just receiving more certificates. That is why we are dealing with a non-taxable stock dividend. Okay, great. I understand that. Now what's going on? If you are receiving a stock, you have to determine what is the basis of the stock that you are receiving, right? Initially, you acquire a certain number of stock and you pay an amount of money, and that was the basis of the stock that you initially purchased. But now that I am receiving more stock, I need to allocate that basis depending on what type of stock dividend I am receiving. And you can receive two types of stock dividends. The first one would be common stock on common stock, meaning you initially acquire common stock and what you're receiving is also common stock. The other would be preferred stock on common stock. I mean, you had common stock and now you're receiving preferred stock. So how am I going to allocate the initial purchase price or the basis on this new stock that I have acquired? Okay, that will depend. The basis of the original shares will have to be allocated to the new shares, but the allocation will depend on what type of shares I am dealing with. Here, if I am getting common and common, I mean more common stock, the allocation will be very straightforward. You just need to spread the original purchase price or original basis over the whole number of shares. And if you are making an allocation on new preferred shares, then we have to make an allocation based on the fair market value. And the holding period, also important because we need to know, is this a short-term asset or a long-term asset? And the holding period for the new stock will include the original stock's holding period. Here we're going to talk about common and common. You are receiving non-taxable stock dividend, and this stock dividend is just more common stock. If that is the case, the cost to acquire the initial stock will have to be spread across all shares. So you're gonna see that here. Okay, example 18. Susan owns 100 shares of Sparrow Corporation common stock for which she paid $1,100. She receives a 10% common stock dividend, giving her a new total of 110 shares. She received 10%, 10% of 100 is 10, so she now has 110 shares. Before the stock dividend, Susan's basis was $11 per share. How? 1,100 divided by 100 shares, that will give you $11 per share. But now that Susan has 110 shares, we will have to spread all the bases, the initial bases, across all 110 shares. So the basis of each share after the stock dividend will be $10 because we have this initial original basis, 1,100 divided by 110 shares. That will give you $10. Okay, so you see the difference. Initially, she had shares with basis of 11. Now she has shares with basis of $10 per share. So now let's look at the stock dividend, but when you are receiving preferred on common stock. If the non-taxable stock dividend is preferred, the cost of the original common shares is allocated between the common and preferred shares on the basis of the relative fair market value. Okay, so now we are not just gonna spread the original basis. What we're gonna do is we're gonna allocate the basis on these different stocks based on the relative fair market value. So how are we gonna do that? Here we have an example. Example 19. Fran owns 100 shares of Cardinal Corporation common stock for which she paid $1,000. She receives a non-taxable stock dividend of 50 shares of preferred stock, okay, on her common stock. The fair market value on the date of distribution of the preferred stock dividend are $30 a share per common stock and $40 a share for preferred stock. So we're looking at the fair market value on the date of distribution, because that's when we're going to do the allocation. So the fair market value of a stock on the time of distribution is as follows. For all the stock that she has is $30 times 100, that will be 3,000. Fair market value of the preferred stock, $40 times 50, that will be 2,000. Okay, that will give us a total amount of 5,000 of fair market value. We are just looking at the fair market value of all the assets. So now we need to allocate based on the relative fair market value. Okay, so we need to compute the ratio. So here, the ratio for common stock is 3/5. We are dividing the fair market value of common stock by the total fair market value. That is 3,000 divided by 5,000. That gives us 3/5. That is the ratio. And the ratio for preferred stock will be 2/5. The difference, or if you just want to run the formula, it would be the fair market value of preferred stock divided by the total fair market value, 2,000 divided by 5,000. That gives you 2/5. Okay, now we're going to allocate the basis. So 3/5 of the original basis, $1,000, that gives you $600. That will be the basis for all common stock. Basis for preferred stock will be $400. For all preferred stock, the basis is $400. So if I want to know what is the basis per share or per stock, just need to divide the allocated basis by the number of shares, and that will give you common stock basis will be $6 per share. Preferred stock is $8 per share. So you have $400 divided by 50, that will give you $8 per share. Okay, so you cannot just spread the basis across all stocks like that you have received, like we have done when you receive common stock. Here you have to allocate the basis based on the relative fair market value of the stock in this way. Okay, gift basis. When a taxpayer receives property as a gift, the donee, the recipient of the gift, has paid nothing to acquire this asset. So whenever we're dealing with determining what is the basis, we need to be careful not to apply cost basis provisions, because under these rules, the donee's basis will be zero. Why? Because the donee never paid anything to acquire this asset. So we're going to apply special rules looking at the date of the gift, the basis of the property to the donor, the amount of federal gift tax paid, and the fair market value of the property. Gift basis for subsequent gain. Here, we're looking at the donee. The donee is trying to transfer the property, and we are expecting a gain from this transaction. The basis in this case will be called gain basis. And what will be the basis for this particular donee? Carryover basis or the donor's basis. Okay, so whenever you hear gain basis, just remember this is a carryover basis or this is the donor's basis. The gain basis may be increased if donor incur in gift tax on the gift. Okay, so if the donor has paid gift taxes, then this basis will increase. The holding period will include the donor's holding period in this type of transaction whenever there is a gain basis. Okay, so just remember the holding period will include the donor's holding period as well. Now, it may happen that whenever the donee is transferring the property, a loss is being generated. So if that is the case, after the transfer, a loss will be expected, then the basis for calculating any loss will be the lesser of the fair market value of the property at the date of a gift or the donor's adjusted basis. That's it. So it's kind of very simple to determine basis for the donee. At any given time, there is only two possibilities, either the donor's adjusted basis or the fair market value of the property at the time the gift took place. So here, if there is a gain as a result of the transfer from the donee to another person who's paying something to acquire the property, then we're going to use gain basis. That means that we are using carryover basis, meaning we're taking the basis of the donor and we are carrying that over to the donee. That's what we're using. And the holding period will include also the holding period of the donor. the time that the donor had this property. Now, in a loss basis scenario, we just have a situation where a loss is going to be generated. And in that case, what the basis is going to be either the fair market value of the property at the date of a gift or the donor's adjusted basis. And the holding period will start when the donee acquire the property, when the donee receive the property. Okay, now let's look at another scenario. The gift basis will be the same as the purchase price, and that will generate no gain or loss. When will this happen? It will happen when the amount realized from the disposition of this property falls between the gain basis and the loss basis. Okay, so when that happens, then there's no gain or loss. We're just going to assume that the basis is the amount realized. And there's no holding period because there's no tax to calculate. There's no gain or loss. Here's kind of a summary if you want to look at the rules in a different way. If the fair market value of the property on the date of the gift exceeds the donor's basis, then the recipient's basis is carryover basis. Again, if the fair market value of the property on the date of the gift exceeds the donor basis, then the donee's basis is a carryover basis. Now, if the fair market value of the property on the date of the gift is less than the donor's basis, then we need to analyze a dual basis situation. Okay, we have special rules regarding dual basis because we may have a gain or we may have a loss. So here the donee has one basis for measuring the gain and another basis for measuring the loss. This is why we call it dual basis scenario or special dual basis rules. When the property is sold at a gain, then we're going to use carryover basis. And we have learned that here, right? And what is the carryover basis? The basis of the donor. So whenever we are selling a property at a gain, we are going to use carryover basis, the donor's basis. Now, if the property is being sold at a loss, then we're going to use loss basis. And this will be the fair market value of the property at the time the gift was acquired. So you can also look at the rules in this way. Look at the fair market value, see if the fair market value of the property exceeds the donor's basis whenever that gift took place. If that is the case, use the carryover basis as the basis for the donee. If the fair market value of the property in the date the gift took place is less than the donor's basis, then you have to further analyze if you are gonna get a gain as a result of the transfer or a loss. If there's a gain, then you use carryover basis. If there is a loss, then you use loss basis, which in this case is fair market value. I'm just here breaking down the rules and trying to explain what is it, what does it mean when they say dual basis rules will apply. But just remember that whenever you have a gift and you're trying to determine the basis for the donee, you just have two options, either donor's basis or the fair market value of the property. Okay, and it's generally carryover basis, unless you're calculating a loss, and in that case, it will be the lesser of carryover basis or donor's basis or the fair market value of the property at the time the gift took place. I think that is a simpler way to see it. So let's look at this example, example 21. Bart purchased stock in 2024 for $10,000. In 2025, he gave the stock to his son Cliff when the fair market value of the property was $7,000. Later, Cliff sells the stock for $6,000. Cliff's basis is $7,000, meaning the fair market value, which is less than the donor's adjusted basis. And the realized loss from the sale is $1,000. Okay, so this is the example, but the explanation is here. The sales price is less than the fair market value and also less than the carryover basis or the basis in Bart's hands whenever he acquired the property. Here we have a loss because the sales price is less than the fair market value of the property when the gift took place, and also the basis in the donor's hand, $10,000. That's why we know that we are going to calculate a loss basis. And your loss basis is the lesser of these two amounts, carryover basis or fair market value. That is why you have $1,000 of loss, because you are choosing $7,000 as the donee basis, meaning the basis for Cliff. So if sales price is between fair market value and donor's basis, no gain or loss will be recognized. Okay, here we're trying also to tell you, I'm trying to tell you that if the sales price was between 7,000 and 10,000, there will be no gain or loss recognized. Obviously, that is not the case here, but the next example is going to show you that. Okay, so here in our example, we have a loss of $1,000. Result, Cliff reports a $1,000 loss because the sales price is less than the fair market value of the stock when the gift took place. So we're using here a loss basis, fair market value. So regarding gift basis, we have additional rules that we need to keep in mind. There are adjustments for federal gift tax paid. So whenever there are federal gift tax paid by the donor on the transfer, meaning on the gift that the donor made, the portion of the gift tax paid that is related to any appreciation of the property will increase the basis for the donee. The holding period will begin on the date the gift is made if loss basis rule applies. Okay, so here we just say, hey, whenever you use carryover basis, you have to also consider the time that the donor had the property, so when the donor acquired the property. But if we are using loss basis, meaning fair market value of the property when the gift took place as the basis for the donee, then the holding period will start on the date the donee acquired the property. That's it. You just have two options. Basis for depreciation. Here we have a property that can be depreciated or has been depreciated, and this property has been transferred to the donee. Now, the donee is going to continue depreciating the property. So what is the basis that we are going to use? We are going to use the donee's gain basis. And you already know gain basis is carryover basis. And you already know carryover basis is the donor's basis. Okay, so whenever we are using basis for depreciation, we are using the donor's basis. We have here an example of gift basis where Alex is receiving a gift from Beth on June 15 this year. The fair market value of this asset on the date of the gift was $8,000. Beth bought the asset on May 5th, 1985 for $10,000. So here you have two very important details. $8,000 is the value of the asset when the gift took place, and $10,000 is the donor's basis, Beth's basis. If Alex sells the asset for $11,000, there is a $1,000 gain. Okay, here Alex is selling the property for $11,000. So there's a gain here. We already know that there will be a gain here. So we need to use gain basis. And what is gain basis? Gain basis is Beth's basis or carryover basis. So we need to use the $10,000 amount. Alex is selling at 11 minus 10,000, the basis, the gain is 1,000. Now we have another situation. Alex sells the asset for $7,000. Here we already know that there is a loss to be calculated, right? So whenever we're in a loss situation, we know that we have to take the lesser of these amounts, $10,000 or $8,000. The lesser is 8,000 because we need to calculate the lesser amount of loss. That is what we are trying to accomplish. We don't want to allow taxpayers to transfer property and get a huge amount of loss. So we are going to prevent this from happening by letting them know that they need to choose the lesser of the fair market value of the property or the donor's basis. So in this case, it's $8,000 and the amount of the loss is just $1,000. Imagine if we allow Alex to choose the carryover basis, $10,000. In that case, the loss would have been $3,000. We don't want that. We just want him to get the lower amount of the loss. If Alex sells the asset for $9,000, then there is no gain or loss. Why there's no gain or loss? Well, because this is an amount in between the gain basis and the loss basis. The gain basis is $10,000. We know gain basis is the donor's basis, carryover basis. And the loss basis, we have already calculated the loss basis. The loss basis is the lower of the fair market value of the property at the time the transfer took place, meaning the fair market value of the property on June 15, or carryover basis. Okay, so the lesser is $8,000. If the purchase price or the sales price in this case falls in between 8,000 and 10,000, we are going to deem the donee's basis to be just the purchase price. So if the purchase price is $9,000 and the basis is $9,000, then there's no gain. Okay, now let's look at inherited property. Generally, when somebody is receiving inherited property, we also need to be careful in calculating the basis. Why? We don't want to just assign the basis of the person who acquired this property. There's a particular provision that allows the beneficiaries, whoever is receiving the property, to use fair market value of the property at the time of the decedent's death. And that is great. I hope that you remember I mentioned, hey, whenever somebody dies, there's a step up in basis. And in those examples, I was referring generally to real estate because real estate increase in value. So if we have a taxpayer that acquired a property in 1990 and the property was worth $200,000, chances are that if this same taxpayer die in 2025, the property is probably worth $500,000. So if the beneficiary of that estate will receive that property, the beneficiary will get fair market value of the property as the basis. So the beneficiary will not get $200,000 as basis. The beneficiary will get $500,000 as basis. And in that case, you see there is a step up in basis from $200,000 to $500,000. And that is a great benefit for the beneficiary. Okay, so we need to keep that in mind. Now, since we are dealing with fair market value, it can also be the case that the beneficiary can get a step down in basis. When can that happen? Generally, when you are receiving property that decreases in value over time. It would be the case of a car, for example. You purchased this car at $50,000 in 2015. Now in 2025, the car is valued at $15,000. So there is a step down in basis from 50 to 15. Okay, just an example to show you that there can be a step down in basis as well. There is an exception to this rule, and that happens when the executor or the administrator of the estate elects an alternative valuation date. So generally, we are going to look always at the date of the decedent's death. But in this case, we have an executor or an administrator that is choosing an alternative valuation date. So the basis is, in that case, 6 months after the date of death. If the executor or the administrator of the estate elects an alternative valuation date, the basis is the fair market value on that date. And the date is 6 months after the date of death. So the alternative valuation date will be 6 months after the date of death. And the basis will be the fair market value on that date. Inherited property is always treated as long-term property. You can remember that we were just looking at gift basis and we were trying to figure out what was the holding period, right? Because we wanted to know if the asset was a short-term or long-term asset for purposes of calculating taxes on the gain when the donee transferred that property, right? Well, in this case, we don't have to worry about that because we're going to presume that the inherited asset is a long-term property. And it doesn't matter if the decedent acquired the property 1 month before he died. We're just going to consider that the beneficiary that received this property is receiving a long-term property. Inherited property valuation date. Here we're talking about the same, the alternative valuation date. Okay. Here we are dealing with an alternative valuation date because we are filing a tax return. Here we're filing a 706 tax return generally because there is a taxable estate. And when there is a taxable estate, well, when the value of the estate exceeds $13.99 million, close to 14 million. And in 2026, it will be $15 million. So whenever you have a taxable estate, you have to file a Form 706. And in that form, you have to provide the value of the assets. And you will have the option to say, hey, the value of the assets that we are considering for purposes of calculating estate taxes is the value at the time of death or the value at the alternative valuation date. Okay, let's continue. Here we have an example of an inherited asset. At Rex's date of death, April 30 of this year, his assets had an adjusted basis of $200,000 and a fair market value of $700,000. If the property valuation date is selected, then we have to choose the value of the property at the time of death. Let's look at this example. At Rex's date of death, April 30 of this year, his assets had an adjusted basis of $200,000 and a fair market value of $700,000. Okay, this is the perfect example of a situation where you're going to find a step up in basis. Here, if the property valuation date is selected, meaning I'm not choosing an alternative valuation date, I'm just using the value of the asset at the time of the decedent's death, then the basis for the beneficiary will be $700,000. Now, we have another situation. October 30 of this year, 6 months after the date of Rex's death, the asset had a fair market value of $650,000. If the alternative valuation date is selected and the assets are distributed on November 10, the beneficiary's basis is $650,000. Now, here we have another situation where the assets are distributed to the beneficiaries before this 6-month period. And if that is the case, we're going to choose the value of the asset at that time as the basis for the beneficiary. Okay, so here, if the alternative valuation date is selected and the assets are distributed on June 30, when the fair market value of the assets is $670,000, the beneficiary's basis is $670,000. Okay, there's an exception here because we're making distributions at an earlier time. Income in respect of a decedent. In this case, we're looking at somebody that just died but was expecting to receive certain payments like wages, commissions, retirement accounts, retirement distributions, and more. And these amounts would have been included in income if the decedent was alive. Well, now he is deceased, and these amounts will be included in the estate's income tax return. So that's what's happening, okay? And what happens here? Are we going to step up the basis? Are we going to consider this amount that we are paying in taxes in the calculation of the gross estate somehow? Well, the answer is no. We're not going to make any adjustments for the basis of these amounts, even if we are paying income taxes. Okay, so the only thing that is going to happen here is that you're going to have to include this income in your income tax return for the estate. And whenever you are filing your 706, you're going to include these amounts as part of the estate, but there's not going to be any adjustments, step up or step down basis. So these rules related to step up or step down basis will generally apply to any property interest, capital assets, but not the right to receive income. Survivor's share of community property. When the decedent is married, we have to see if they have joint property. Because if they have joint property, there are special rules that will apply if they are living in an estate that is considered a community property estate as opposed to a common law estate or separate property estate. So we are looking at a joint property and the decedent owns this property together with his spouse or her spouse. In this case, we are going to give a full step up in basis for the whole property value, as opposed to just stepping up half of the property because half of the property belonged to one of the spouses, in this case, the decedent. Okay. However, if we are in a separate property state or common law state, only half of the jointly held property of these spouses will be included in the estate. So in that case, no adjustments of the basis is permitted for the surviving spouse's share. However, in the community property estate, the basis of the community property will be equal to the fair market value of the property. So the surviving spouse's share is deemed to be acquired from the decedent. That is why we are stepping up the whole property. We are stepping up the basis of the whole property and not only half. Okay. In summary, in simple words, community property estate, there's going to be a step up in basis in the whole joint asset. Common law estate, there's going to be a step up in basis only in half of the asset, half of the property. And here we have an example. Andrew and Latonia owns as community property 200 shares of Billmore Company stock acquired in 1993 for $100,000. Okay, 200 shares and the basis is $100,000. Andrew dies in 2025 when the securities are valued at $300,000. So that is the fair market value. One half of the Billmore stock is included in Andrew's estate. If Latoya inherits Andrew's share of the community property, the basis for gain or loss is $300,000. So here, one thing that you need to notice is that only one half of the stock is included in Andrew's estate. What does that mean? It means that we're preparing a 706, a tax return, and we are including only the property of the decedent, and we're just going to include one half of the property. So whenever we're looking at the basis for Latonia, who is actually receiving the property, now she is the owner of the whole property. Before she just had an interest, half interest in this property, but now that her spouse has died, she's the sole owner of the property. So because she lives in a community property estate, the basis for Latonia will be $300,000. Why is that? Because we are going to assume that she has received this property as an inheritance from Andrew. Okay, we're just going over these rules. The surviving spouse's share is deemed to be acquired from the decedent. So we are just assuming that she had acquired this share from the decedent. And whenever you are acquiring a property from a decedent, you have a step up in basis. The basis of the property that you are acquiring is the fair market value of the property. Okay, in this case, she's receiving half from the decedent. A lie, that's not true. She's not receiving anything from the decedent. We're just assuming that that happened, okay? That is why the basis here is $150,000. Now, the other half, Andrew's one half of the community property that she is really receiving will get a step up in basis from 50 to 150 because we're including this in the decedent's gross estate. So yes, there's a real step up here because we're including this half on Andrew's estate. In simple words, community property that is owned by two spouses will get a basis for the beneficiary or for the surviving spouse equal to the fair market value of the property. Let's look at the big picture scenario. Alice and various other family members inherited property from Paula, who died in 2024. Now here, Alice is receiving a home, and they are letting us know that the basis for Paula was $275,000, meaning that's what Paula paid, or that is probably the adjusted basis for Paula, okay? So at the time of death, Paula's basis was $275,000. Now, the fair market value of the property at the time of death was $475,000. And the question to you is, what is Alice's basis on this house? According to the rules, it will be the fair market value of the property inherited, right? The fair market value of the property inherited is $475,000, and that will be the basis for Alice. And if that is the case, we are looking at a step-up basis scenario. These allow losses. Now we need to look at these rules that will prevent the taxpayer from claiming certain losses. Okay, so the particular provision is in Code Section 267 that says realized losses on sale of assets between related parties are disallowed. So this particular section disallow losses between related parties. Who are related parties? Family members, corporation, and a shareholder who owns greater than 50% of the corporation. Now, note here that it says directly or indirectly. We have a corporation and we have the shareholder, that is a direct ownership. If this shareholder owns more than 50% of that corporation, this corporation and the shareholder are related parties. That is very easy to see. But they also say indirectly. That is a more complex structure. For example, when you have multiple corporations, let's say here you have the taxpayer and then you have one corporation and then another corporation underneath, you will see that the shareholder on the top can be considered to own indirectly the corporation all the way down. So you have shareholder, corporation A and corporation B. The shareholder on the top indirectly owns corporation B at the bottom. Okay, so that is an example of indirect ownership. Also, you can find related parties in partnerships. Whenever we have a partner who owns greater than 50% of the partnership interest, really worry about what's going on between these related parties. There is a sale. And the concern here is that we are trying to prevent a taxpayer from directly transferring an unrealized loss to a related taxpayer in a higher tax bracket who could receive greater tax benefit from the recognition of loss. So whenever we're looking at this allowance of losses, one thing that we need to remember, we have related parties, there is a sales transaction, and the loss of the seller will be disallowed. Let's say a father is selling a stock to his daughter and the fair market value of the stock is $10,000, but the basis for the father is $12,000. So there is a $2,000 loss that will be disallowed. He will not be able to recognize this loss because he's transferring the stock to his daughter. The rules tells you that he will not be able to use that loss at all, but the daughter will be able to use that amount to reduce her gain when she later sells the stock to somebody else. So that is how the rule works. So now we have an important note for you. Here we're saying these rules prevent the taxpayer from directly transferring an unrealized loss to a related taxpayer. So let's say here the father is trying to transfer the property to daughter because she could potentially sell this property also at a loss. And then because daughter is in a higher tax bracket, she will get a higher benefit from this loss. But the rule prevents the daughter from using this disallowed loss whenever she is later selling the asset. There's not going to be any adjustment for the loss that was disallowed, only for the gain. Okay, because we are trying to prevent family members to enter into these transactions to kind of shift the loss or shift the gain as well. How can you shift the gain? You can sell the property. Father could potentially sell the property to daughter at a loss. Father will get a deduction for this loss, potentially. But under the rules, he's not going to be allowed to get a deduction. And then later, daughter, who is in a lower tax bracket, sells this property and then she pays lower taxes because she's in a lower tax bracket. You see how we are trying to shift the gain or the loss? Well, these rules are preventing taxpayers from engaging in those transactions because they're very easy to enter into these transactions. We're just dealing with related parties. So we do not trust that this transaction really is an arm's length transaction. Okay, here, now we have disallowed the loss. What's going to happen with the basis for the buyer, where the related party buyer will have a basis equal to the amount that the buyer paid. That's it. In my example, with the father and daughter, father selling a stock to daughter, the stock basis was $10,000 and the sales price $8,000. So in that case, the $2,000 of loss will be disallowed and the basis for daughter will be $8,000, which is the amount that she paid. And here, the last part is illustrating the rule that I just mentioned. For income producing or business property, any loss disallowed can be used to reduce the gain recognition on subsequent disposition of asset to unrelated parties. So here daughter is selling the asset to an unrelated party and the result is a gain. In this case, daughter can use this amount that was disallowed to reduce her taxable gain. Let's say later she sells this same stock at $20,000. The gain will be $12,000, but she can reduce that amount of her gain by the loss disallowed, which in my example was $2,000. So the total amount of her gain will be $10,000. Okay. Holding period of the buyer for the property, it will not be affected. It will be the time when the buyer acquired the property. Wash sales. Here we're going to disallow losses as well, but we're dealing with a taxpayer that is selling stock or securities at a loss, and within a certain period of time is acquiring substantially identical stock or security. And what is this time? 30 days. 30 days before or after the date of the sale when the loss occurred. So a wash sale occurs. Wash sale occurs when the taxpayer disposes of stock or security at a loss and acquires substantially identical stock or securities within 30 days before or after the date of the loss sale. The realized loss that is not recognized under a wash sale rule is added to the basis of the substantially identical stock that the taxpayer is purchasing. The holding period of the new stock or security begins on the date of acquisition of the old stock. So what's happening here? First, there's a wash sale. I'm selling assets, and within 30 days, I'm acquiring kind of the same assets. Okay. If as a result of that sales transaction, there's a loss, we're going to disallow that loss. But what's going to happen? Am I going to lose this loss? No. We're going to add that loss to the basis of the new stock that you are acquiring. And what's going to happen with the holding period? Well, it will include the holding period of your old stock. Okay, so the holding period for the new stock will start on the date of the acquisition of the old stock. When a taxpayer acquires fewer shares than the number sold, then there is an pro rata allocation of the basis. Okay, now let's review this example. On January 2nd, 2024, a taxpayer acquired 100 stocks or 100 shares of ABC Inc. and paid $2,000. Then on May 1st, 2024, this taxpayer sells 100 shares of the corporation and the selling price is $1,200. There is a loss in this case because his basis was $2,000. The loss is $800. So here we're going to see two scenarios. First, there's wash sale. And the second, there's no wash sale because he sold the stock. First, there's a wash sale because he sold the shares on May 1st, 2024, and then he purchased new shares on May 14, 2024. So he purchased 100 shares of the same corporation and his cost was $1,400. Because this will be a wash sale, the result will be that the $800 from the May 1st sale is disallowed. Okay, so we are here, we are looking at this scenario, $800 from the sale will be disallowed, but the basis for the new shares will include this amount of loss. So it will be the amount that the taxpayer paid, $1,400 plus $800 of disallowed losses. The holding period will begin on January 2nd, 2024, okay? The time when the taxpayer acquired the old shares. Now, in this scenario at the bottom, we have an example of no wash sale. Why? Because the taxpayer sold the 100 shares in May 1st, 2024, but acquired new shares on June 5th, 2024. So if you don't want your transaction to be categorized as a wash sale, just wait more than 30 days. So in June 5th, 2024, the taxpayer purchased 100 shares and paid $1,400. This is not a wash sale So the result will be that the $800 of loss will be allowed, okay? He will get a deduction for this loss. The basis of the shares purchased on June 5th will be $1,400, and the holding period of the shares begin on June 5th, 2020. Because nothing happened here, we're going to respect the transaction. We are going to allow the loss. We are going to use the purchase price as the basis for the taxpayer, and the holding period will start on the date the taxpayer acquired the new share. We have an example here in the big picture. Alice owned 100 shares of Green Corporation stock. She sold 50 shares for $8,000. Okay, so Alice purchased 100 shares at $20,000. And then she sold 50 shares for $8,000. As you can see here, there is a loss of $2,000. But 10 days later, she purchased 50 shares of the same stock for $7,000. What is this? A wash sale. 10 days later, she should have waited if she didn't want this transaction to be categorized as a wash sale. Alice's realized loss of $2,000 is not recognized because it resulted from a wash sale. Alice's basis in the newly acquired stock is $9,000. Why? Because we're adding the disallowed loss to the purchase price. $7,000 plus $2,000, her basis is $9,000. Okay, and the example continues. Let's continue looking at this example. Now assume the same facts, but instead of purchasing 50 shares of Green Corporation stock for $7,000, meaning $140 per share, Alice purchased only 40 shares of the stock for $5,600. Alice replaced only 40 of the 50 shares previously sold at a loss. So what's going to happen here? We have to prorate this amount realized. So we are not going to completely disallow the whole amount of the loss. So where are we? We're here. When a taxpayer acquires fewer shares than the number sold, loss from the sale is prorated based on the ratio of number of shares acquired to the number of shares sold. So here we are looking at the same example, but now assume that instead of purchasing 50 shares of Green Corporation stock for $7,000, Alice purchased only 40 shares of stock for $5,600. Alice replaced only 40 of the 50 shares previously sold at a loss. So we need to look for the ratio of the number of shares acquired to the number of shares sold. So we are going to have here an 80% of the shares were just acquired. So only 80% of the $2,000 realized loss will be disallowed. So that means that only 80% of the $2,000 realized loss is disallowed, only $1,600. As a result, Alice will recognize a $400 loss. We are just disallowing $1,600. She can still recognize a $400 loss. She will have a basis of $7,200 in the 40 shares of Green Corporation she purchased. How so? Well, she paid $5,600. That is the purchase price. And we are disallowing a loss of $1,600. That increases her basis, and that is why she will end up with $7,200 as basis in these 40 shares. Now let's look at another situation. Losses are also disallowed when you convert personal property to business property. Okay, so why this is happening? Well, we know that loss on the disposition of personal property is always disallowed. We never get a deduction for losses that result from the disposition of personal property. That is the general rule. Now we are looking at a situation where the taxpayer is trying to convert personal property to business property, a property that he says he's going to use to produce income. This is a business or income producing property. When that happens, we are going to disallow certain losses, okay? So in this scenario, the law is preventing the taxpayer to convert a personal use asset that has declined in value to business or income producing use, and then sell the same asset to recognize a business or income producing loss. So what is the adjustment that we have to consider? What are the rules? The rules say that original basis for loss on personal use asset converted to business asset is the lower of the property's adjusted basis or the fair market value on the date of conversion. So what type of personal use assets are we talking about? Generally, we know that we can use our personal car for our business, right? So we are going to say, hey, my personal car now is going to be converted and it will be used in my business. And you know, when you purchased a property a couple of years ago, the value of your car was probably, I don't know, $50,000. And as years passes, the value will decrease. And now when you converted the asset, when you converted this car, the value of your car was, let's say, $40,000. Now we're in the situation where you are using this property, this car in your business, and you sell the car to somebody else. You are going to get a loss, right? You're going to be inclined to say, hey, my loss calculation should start from the basis of this property. When I purchase my car, my basis is $50,000. Well, we are going to tell you no so fast. Your basis for calculation of loss will be the lower of the property's adjusted basis, in my example, $50,000, or the fair market value of the property when you converted this asset to a business used asset. And what is that? $40,000. So your basis for calculating losses will be $40,000 instead of $50,000. But now let's look at other type of personal assets that you can convert into business. A car is one, your personal computer if you start a freelance business, a camera if you are in a photography business, your house if it was your personal property, your vacation home, and now you're using that as a rental property. Okay, so all those are examples of personal use assets. And here the rule is saying whenever you have this type of assets, if you are selling these assets, an asset that initially was a personal asset and then converted to business asset, you are going to have to use as basis the lower of the property's adjusted basis or the fair market value of the property at the time you converted this asset. Basis for loss is also the basis for depreciation. If we are going to depreciate, we are going to use the property's adjusted basis or the fair market value on the date of conversion, whatever amount is the lowest. This is an exception to the general rule that says that basis for depreciation is the gain basis. I hope that you remember because we just look at this whenever we're looking at gifts. We say, what is the basis for depreciation on properties that I receive as a gift? Well, it is gain basis. And what is gain basis? Gain basis is carryover basis or it is the donor's basis. In this case, we're not using the donor's basis, the carryover basis, the basis when you initially acquire the property. We're just going to look at the basis at the time of conversion if that is the lower amount. Okay, so we're preventing the taxpayer from recovering a personal loss indirectly through depreciation of the higher original basis. Okay, now we are in the end of the chapter. I want to go over this example because this example brings everything home. It's a summary of everything that we have covered so far. At the beginning, we told you that Alice inherited a house from her mother, Paula. The fair market value of the house at the date of the mother's death based on an appraisal was $475,000. According to several real estate agents, the house likely is worth now $485,000. Paula, her mother, lived in the house for 38 years, and her adjusted basis for the house was $275,000. As a child, Alice lived in the house for 10 years. She has not lived there during 25 years. She had been married. The house has been vacant during the 7 months Alice has owned it. That is an important detail, the fact that she is not living in the property, because we're trying to tell you that she will not be able to claim the $250,000 exclusion that applies to all homeowners, everybody that is selling their principal home. If we just stay here, we can figure out a few things. What is her adjusted basis? Her adjusted basis will be the fair market value of the property when her mom died, because this is an inherited property, and whenever you receive an inherited property, you're receiving the fair market value of the property at the time of death of the person who is giving you the property. And in this case, it's $475,000. That would be her basis. So Alice's basis has been a step up as a result of Paula's death. Alice's basis is not going to be $275,000. It will be $475,000. This is an important example that we use in tax planning in general. Many people ask this question: hey, can my mom give me the property? I'm the sole heir. Is it a good idea to get this property now as a gift, or should I receive the property when my mom dies? And as you can see, it is better to inherit the property, because if Alice had received the property as a gift, then we have to use either carryover basis, or if we are going to determine a loss, which is not the case, we use the fair market value of the property when the property was gifted, and we use the lesser amount of those, okay? The lesser of both will be carryover basis, will be her mom's basis. If this was a gift, Alice will have received a basis of $275,000, and that is very bad. So the fact that she inherited the asset is a good thing for her. Now let's continue. Alice has been trying to decide whether she should sell the house for its fair market value or sell it to her nephew for $275,000. Obviously, we know that the fair market value is $485,000, but she's thinking, hey, maybe if I just give this property to my nephew, there will be no tax consequences. So Alice has suggested a $275,000 price for the sale to Dan, and she believes she will have no gain or loss at this price. Well, she is mistaken, right? Here we are in between related parties, and if there is a loss, we know that the loss will be disallowed, right? She is going to have to pay taxes if there's a gain. If there's a loss, the loss will be disallowed. Alice intends to invest the $275,000 in a stock. Great. You advise Alice that her adjusted basis for the house is dollars fair market value on the date of her mother's death. Okay, so now she knows that my basis is, so now Alice will know that, hey, if I sell this property at $485,000, my gain is going to be only $10,000. As you can see here, if Alice sells the house for $485,000, she will have a recognized gain of $10,000, just a difference between the purchase price and her basis. So now let's analyze the situation where Alice sells the house to her nephew for $275,000. If she does that, there will be a part sale and a part gift situation. Why? Because the value of the property is $485,000, and she's only getting $275,000. Anything left, it will be a gift that she made. Okay, so if we calculate the difference, look at the bottom, the gift will be $210,000. That is very easy to see. But now we have to calculate what is the realized gain on the sale. To calculate the realized gain, we need to calculate the basis. What is the basis on the portion that you sold? We already know that the amount realized is $275,000, and we need to find out what is the portion of the basis that we are allocating to the sales price, and the basis will be allocated based on the ratio of the sales price and the fair market value of the property. And if we do that, you see here at the bottom, 275,000 divided by $485,000. That will be the ratio, and you multiply that by the adjusted basis that she has on this property. And what is the basis that she has on this property? 475,000, which was the fair market value of the property when she inherited the property. The result of this calculation will be $269,330. And if you subtract that from the amount realized, you get a gain of $5,670. Okay? But now let's look at this in another way. So I'm breaking this down for you so you can clearly see it. The scenario tells you Alice sells the house to her nephew for $275,000. The fair market value of the house is $485,000. Alice's original adjusted basis in the house is $5,000. This is the fair market value of the property when she inherited the property. Now, this is the scenario. These are the facts. We need to analyze this situation. What's happening here? Again, what is happening is because the sales price is just $275,000, less than the fair market value, this will be treated as a part sale and part gift. Okay, so a part sale for $275,000 and a part gift for the difference between the fair market value of the property and the sales price, and that is $210,000. Great. Now, whenever we want to analyze the tax consequences, we need to go step by step. First, let's allocate. So step one, compute Alice's adjusted basis allocated to the sale. And in this situation, the IRS will require that we allocate Alice's basis between the sale portion and the gift portion. And the split will be based on the ratio of the sales price to the property's fair market value. We just mentioned that. Again, the split of this basis will be based on the ratio of the sales price to the property's fair market value. Okay, we just divide sales price by fair market value. And then multiply that to the adjusted basis. That will give us a basis of $269,330. So here's the formula again, and this means that the basis to the sale will be $269,330, and the basis allocated to gift will be $205,670. Okay, so once we calculate this, we can determine that the basis allocated to sale is $269,330, and the basis allocated to gift is $205,000. Step two, we need to compute the realized and recognized gain. So the amount realized for Alice, we're just looking at Alice, the amount realized is $275,000. The allocated basis is $269,330. And the difference will be the realized gain, meaning she has to pay taxes on this amount. Remember at the beginning, she was thinking, hey, if I make this gift to my nephew, I will not recognize any gain or loss, right? Nothing's going to happen. Wrong. You have to pay taxes on this amount. Okay, so since this is a sale to a related party, the gain will be recognized. And remember, if we ended up with the loss would have been disallowed. Now, let's analyze the gift portion. Alice is deemed to have made a gift. We already calculated that amount, $210,000, just a difference between the fair market value of the property and the purchase price. That is the portion of a gift. And what are the tax consequences here? Where Alice will have to file a gift tax return, a Form 709, right? Not that she will have to pay taxes. She just needs to subtract the annual exclusion, and the annual exclusion for this year is $19,000, and the remaining amount will have to be reported as a gift. Why are we doing this reporting? Because we are going to let the IRS know that we are reducing our lifetime exemption amount of $13.99 million, which soon will be $15 million in 2026. Okay. So Alice needs to file a gift tax return, Form 709. Step 4, basis for her nephew. We already know that the sale portion is $275. Great. That is the amount of money that he paid. So that will be part of his basis. So now let's look at the gift. This is the gift, and what is the basis for this part of the property? What is the donor's basis? In this case, we already calculated that. Alice's basis for the gift is $205,670. But we are not gonna say that this will also be the basis to the nephew, right? No, we have to wait and see if later when nephew sells this property, this is gonna generate a gain or a loss. If this generates a gain, the basis for nephew will be donors basis, carryover basis, gain basis. Hopefully you remember that. And what is that? Donors basis, carryover basis, gain basis is just the basis of the donor. That is just $205,670. That would be the nephew's basis. But if the nephew sells the property at the loss, then we will have to see what is the fair market value of the property at the time of the gift. The fair market value of the property at the time of the gift. And we also know that, right? The fair market value of the property at the time of the gift was $210,000. That was the fair market value of the portion that he received. Okay, so that's it. This is a summary of everything that we have covered so far. Try to review this example. And with that, I thank you for your attention.